India is one of the largest consumption bases in the world.
India being a very large economy and the largest market outside China for pretty much everything you see around, self-sufficiency itself is a very large opportunity for the next decade. The conviction of the theme is now even higher than was probably even before. Export is a top story. Export remains a good piece of the business. It's a cherry on the top. India has always been a late adopter of technology, but when it adopts, it becomes one of the champions of the technology.
Okay. Hello everyone. Welcome to this session titled Insights on HDFC Manufacturing Fund. We are here to discuss in detail the overall outlook on the manufacturing theme, what makes it one of the most important investment theme for the next decade in the country. We'll also discuss in detail the portfolio positioning of our fund, and we have with us Rakesh Sethia, who manages HDFC Manufacturing Fund. Hi Rakesh, welcome to the show.
Thank you, Ram.
So to begin with, Rakesh, I just want to highlight in the last 2 years since the launch of our fund, there have been many challenges, especially to begin with the trade tariffs that was imposed on us. We saw a major war break out in the Middle East, sending oil prices sky high. I'm sure both of these events had a lot of impact on the overall manufacturing sector. The big opportunity remains. I mean, India is one of the largest consumption bases in the world. When we talk of consumption, there was some concerns of the consumption slowing down, which was followed by a host of measures by the government also that kind of tried to propel the consumption. Now it looks like the war is over. I'm not going to ask you exactly is this over finally. But as we stand today at this juncture, what's your overall outlook on the theme as such?
So from the time when we launched the fund, our core thesis of manufacturing was that India being a very large economy and the largest market outside China for pretty much everything you see around, whether it's B2B consumption, whether it's B2C consumption, or is B2G consumption, right? That demand, that market size gives us a scale to be cost competitive, and therefore to just produce for your own consumption, self-sufficiency itself is a very large opportunity for the next decade.
Right.
As the economy, despite these challenges, have been able to grow in a very healthy space, I think that conviction remains. What has happened, as you rightly highlighted, the two challenges we have seen. So I think that puts the need for the self-reliance and the diversification of trade to avoid weaponization of supply chains, what you've seen in the last few months or so, is probably even more higher, right? And that is at the top of the agenda for all the policymakers, not only for India. We have seen for example, coal gasification policy that was announced about last month. But beyond that, you read newspapers across the world, you follow data points across the world. To diversify the trade across the supply chain partners is probably at the top of the agenda, which means that the conviction of the theme is now even higher and was probably even before.
Sure, that explains a lot. You talked about the coal gasification policy, etc. Take us through the entire range of policies announced by the government for boosting manufacturing. I mean, we've seen the ones to boost the consumption as such, but what about manufacturing? What are the 1, 2, 3 steps that we have seen?
Some of the things what come top of my mind over the last few years is PLI, phased manufacturing programs, India Semiconductor Missions, and there has been various host of tariff and non-tariff barriers, right? These policies have led to better economic outcomes for manufacturing. So, for example, let's say when we talk about PLI, look at electronics, mobiles specifically. 99% of the mobiles are now made in India. In fact, we have overtaken as the largest exporter of mobile phones getting into the United States last year.
99% of
99% of our mobiles are now locally produced. We are the largest exporter for mobile phone getting into United States. We have surpassed China. But look at these are some of the known examples. Okay, so let me tell you what the tariff and the non-tariff trade barriers have done. Solar as an industry did not exist 5 years back in our country. So industry group as a whole host of companies have invested roughly 25,000 to 30,000 crore of capex over the last 4-5 years. And this year, we are talking about a manufacturing value of close to 1 lakh crores, right? This is an industry did not exist, span of 5 years, and it's a very large. Another 50,000 crore of capex is planned to be getting into this industry over the next few years, right? Because they are looking to backward integration from module to cell to getting into this to getting into even the ingot and the wafer manufacturing, right? So we are trying to capture as much economic value we can in the slower steps. Having said that, I don't think so that everything is a hit. There are misses also. PLI is mobile. Everybody talks about battery PLI did not pick up. Whatever they announced, only 3% of the capacity has come. Same thing about the telecom. Half of the PLI manufacturers could not even meet their incentives. But like what happens in every policy making, there will be hits and misses. On the balance, I see more hits than misses, which proves which puts the confidence that whatever the government is trying to do from a policy making point of view is creating a favorable environment for all the manufacturers across sectors. Whoever can take the advantage of that probably will able to scale up their businesses and we grow profitably over a period of time.
Sure. Let's talk about the exports opportunity from a manufacturing space perspective. Tell us some success stories from the listed space.
Right.
Like be it our portfolio companies or sectors. You may not need to take individual company names, but we can talk about the whole sectors wherein there are some success stories from the point of view of exports.
Okay. So export has been a pain point for our country for some time. And even if you look at, let's say, last 5-6 years, we are growing at about 6%. That is a macro story. But investing is all about micro, right? So even despite the headline exports stuck in that lower than 5-6% growth range, you've seen sectors, for example, cables and wires, they have grown handsomely. You have seen auto ancillary specific examples in that they have been able to grow their exports, and some of them actually become integrated into the global supply chains of the large OEMs. I can talk about speciality chemicals. I can talk about textile as a sector which has emerged. Some of these examples are where we have seen the companies who are willing to invest ahead of the time for the capacities, being able to deliver those products at time, in schedule, at a cost matching to the global levels. They are the one who are being able to integrate into the supply chains and been able to grow their exports. There are portfolio companies. I mean, for pharma, for example, everybody knows, right? But even beyond healthcare and pharma, there are companies where export as a percentage of their profits is now as high as about 20%. This number was probably sub 10%, sub 5% in about 3-4 years back, right? So I see it's a case of doing a more bottom up stock picking, trying to figure out those sectors and the ideas within those sectors who are being able to capture this opportunity. Unfortunately, it's not a what I would call at a country level success story as yet. Having said that, when I look at, let's say, the policy environment around, and when I look at, let's say, what's happening in rest of the world, I am willing to sort of bet or probably been more hopeful that
All
over
the
the
key
next 5 years,
ingredients are
the
there.
ingredients are in the place. Possibly we are about 5 years away when exports start to become a meaningful part of the earnings growth story for the India corporation in general.
So, would the large consumption base alone be enough for the manufacturing sector to grow from a, say, for an investor who looks at this theme at this point in time from a 5-year perspective? I mean, would that alone be enough to give us a run?
Oh yes, I think what we need to appreciate is that we are roughly 4 trillion economy, and you pick up any product around you. I mean, I just take a very simple example: summer conventional AC product, right?
Yeah.
Last year we sold close to 1.4, 1.5 crore ACs. 10 years back, this volume was 30 lakhs. A cost competitive plant requires you to have a scale of about 1 million, so about 10 lakh ACs. Now, the problem in 2015 is that even if, let's say, you can put one plant in the all over country, you could put only 3 plants. You had more than 3 players, which means that if one player decide to put plant in south, what happens to the northern market? There is a freight and the logistics cost that needs to be incurred, right? Now look at last year, we are talking about 1.4 crore AC, which means 14 plants, large scale plants that can be put through. Not only that, you can put in the multiple geographies of the country. So that takes care of the freight disadvantage, as we call it. And by the way, we are growing at about 12%, 13% every year, which means that we can put 1.5, 2 plants every year just to meet our domestic consumption, right? I just took a very topical example of what is prevailing
Right.
around. But this story of that we being a very large consumer market, unfortunately, the word consumption get tagged only to B2C. But look at all the things around you, whether it's steel, whether it's cement, whether it is any metal you can think of, whether you the things, for example, this leather upholstery, everything will become probably either the largest or if not largest, at least among the top 3 large market outside China. That is a very large scale for any place to ignore. That becomes a very large demand environment, and it automatically creates your incentive to produce locally, because that is how you can be cost competitive to deliver your product and services at a scale to the consumers. That's the core thesis of the investing. Export is a top story. Why? Because why the trade happens. One of the reasons that trade happens is, everybody looks for optimizing their own supply chains, right? I mean, a country should, if you go by the theory, a country should be producing where they are most excel at, and they should be exporting what they can, right? That's a fundamental theory of the trade. Now, the trade has been moving for the last 30, 40 years. The key ingredient is the countries who import, they want the lowest cost producer and the reliability in that supply chain. 20, 30 years back, China was the only option. India was also an option. Unfortunately, we didn't have the policy environment. Now, when I look, let's say, ahead for the next 10, 15, 20 years, and you look at the entire supply chain, you look at which are the countries that can provide whatever product you want to think through at a scale and a cheaper cost, and they probably stacks up at the top of the park. And you just need, you just need to create that scale, and export will pick up. Although I'm a big circumspect about whether will be as large as China would be, because normally every time you get to get compared to the China. I think one realization is there, the supply chain diversification has to be there, which means that export remains a good piece of the business. It doesn't become the only piece of the business. That's the way we should be thinking about export. It's a cherry on the top.
Very interesting. I think you spoke about scale, right? Let me ask you this. If we take the largest of the factories or the manufacturing plants in India and compare it to many other nations, now we hear Vietnam and other countries trying to take a chunk of this export opportunity pie. China is always there. How comparable are our factories from a scale perspective, and how have we made this journey over the last 10, 15 years?
So look, we are still not at the level of China, simply because China are very large in the export market. So that puts a constraint, right? I mean, theoretically, we cannot be as big as China when it comes to export. But for a domestic demand part, we have become as large in some of the categories, right? So I give an example. Foxconn's, I think, smallest factory would have something like 100,000 employees, right? We don't have a factory in India which is employing 100,000 employees, at least I am not aware of.
Right.
But we have factories where 20,000 people, 30,000 people
Sure.
are now working in the same scale level, right? What it creates is that, you start to build these ecosystems where at some point of time you'll be able to create that scale. While at 20, 30,000 is not compared to 100,000, but it is a very large number if you compare where we were about 5 years back. I think we are getting into other directions where we are willing to create capacities to meet the demand, and we are able to scale. The current scales have already become 3x to 5x from what we used to do 5 years back.
That's important.
So we are in the right direction rather than comparing at an absolute level between China and India.
Looks like the tariff threat is kind of behind us. We sailed through that period with a good amount of resilience. Looks like the war is also, let's hope that the war is also behind us. And we've also signed a few FTAs, must be important ones, the key ones with UK and Europe. There is a deal that we are trying to make with the US. How important are these from a manufacturing theme?
Well, I think FTAs are very important to be part of the global trade network. And these 3 FTAs are in the right direction. And just to put this in the context, in the last 12 months, we could achieve what we did not in last 12 years. So that tells you a lot of things that probably would have gone in the background in achieving some of the deals. Having said that, I think UK FTA is more or less done. So I think there's an expectation that the trade could increase from $56-57 billion to about $120 billion. Europe would still require some time before start to make an impact, because the European Parliament is still to ratify their part of the deal. And US is where, I would call it that there's a lot of deal that is signed, but there is a lot of legal text that is missing. So we really don't know what's really in the fine print of the deal, is as I would put it. Having said that, I think all of these are as in the right direction. Now, obviously, people talk about, who are the winners of, I mean, wherever we could take advantage. So, for example, I could think through sectors like textile, auto ancillaries, engineering goods. There will be obvious beneficiaries of some of these FTAs, right? But I have a different perspective on, at least in Europe, FTA. What possibly it may unlock is the incoming FDI from the European MNCs, and they are very important, because what people forget is that even when China was growing in export, let's say in 2005, that's the data point I at least remember, 58 to 60% of their exports were from MNCs.
Okay.
It's not the local champions, as we call them. They came only much later, probably 10, 12 years later. So that 58% number by MNCs is now 34%. So obviously and absolute value has grown, but the relative share has declined because the local champions have emerged. I think if India has to grow, export, as we speak about in our second and third question, one of the things is, we need to invite these MNCs. This FTA creates this enabling environment, and especially in the context of Europe, where they are struggling with high energy costs, they are struggling to get skilled and the talented labor. Some of these problems we are able to solve being in India, and we are creating a policy framework which is more enabling in the nature. Coupled with FTA, allows you to bring some of those factories, or at least part of those factories, in the country, and that's how you get integrated into the MNC value chain, as they called the global value chain for the trade. I think that's where I would be more looking up. The usual part of the trade is known and expected. I am probably looking at maybe it will open up the door for a lot of FDI coming from Europe into the India, specifically for the manufacturing part.
Superb. Let's talk about the infrastructure build-up. We've had historically infrastructure bottlenecks when it comes to transportation of goods, etc. But in the last decade, we have improved kind of leaps and bounds. So take us through the journey, what we have done, where we have progressed, and where we are likely to progress in the next 5 years.
One of the things which gets discussed about the exports always is that, is the cost is the only variable. Cost is probably second or third variable. Most of the time, people actually ask for the reliability of the supply chain. And 10 years back, that was not the case with our country, because we had long lead time with our ports. We did not have scheduled services of exporting goods from factories to the ports. It took more time. We didn't have enough space at the airports. For example, electronics manufacturing requires a dedicated space at the airports to be able to deliver goods in time. Some of these infrastructure were missing. Even if you were theoretically, even if you were a large producer, cost competitive, you could never have this conversation with your potential customer that I'll be able to provide so and so quantity at so and so time, and keep on doing that at a regular interval, right? There was always this volatility of try to meet your supply chain criteria. I think with the investments in the roads, investments in the ports, and I'm clubbing both the public and the private sector investments, because port has partly privatized, partly in the hands of the public. Some of our lead times now are as competitive as we would see even comparing to China, for example, right? Port dwelling time, we are one of the lowest. There was a time when, and I read the statistics, I found it very funny. Gujarat ports had a faster turnaround time even compared to Singapore, which is considered to be one of the most efficient port, right? Some of the parameters we are able to match. I think there is still a lot of work to be done. So, for example, our logistic cost still remains high. We still need a lot of container movement that needs to happen at our level, simply because it's green, so it meets our ESG goal. Also, it's cheaper, but we are still taking more time, and we are still putting some infrastructure in the place. But I think again, everything is in the right direction. So, a lot of investment has already happened, but still we need to put more to make it more enabler. Railway capex is now what, 2,50,000 crores roughly. Yeah, this number 10 years back was about 24,000, 25,000 crores. So we have increased by a factor of 10x. That is why you see that in some of the industries, we are now being able to become not only cost competitive, but a reliable supply chain partner. Again, the airports is a less spoken story. The number of airports in our country in about 7 years has gone from less than 70, 80 to close to 160 now. that itself is a very large enabler of being able to move at least the goods where the supply chain and the time to market is very, very important.
Rakesh, we have always highlighted, I even go back to our NFO presentation, the labor cost advantage that India has always been having.
Yes.
And this is the age of AI and automation. And this is often talked about that this may not kind of translate to huge gains in the age of AI and automation. We hear about dark factories in China wherein there is no single person in the factory. There is machines silently work. There is no need for air conditioning also when there is no need for space for a cafeteria, or even toilets are not needed in those factories. So given these kind of technological advancement, how are we going to reap this kind of potential that we have?
So I think, for India, the labor and the AI is not a binary choice. We need to probably sequence it. What I mean by that is, that the AI and the labor has to be complementary in the nature to take advantage of the thing. So I give an example. Let's say there are sectors which are labor intensive in nature by design, right? So you, even if you're in China and you're doing the same, for example, let's say textile, leather goods manufacturing, right? Somehow even mobile assembly, fundamentally they remain assembly heavy, and therefore they require human intervention. So when you require human intervention, by definition you are not able to automate to the level of 100%, which means that the labor becomes the inherent advantage from a cost perspective, right? But using AI, what you can do is, cut down on the defects pieces, because humans are tend to make more errors as compared to machines. So take an example of a mobile assembly factory. By putting AI visual sensing, you can detect faulty pieces faster than probably human would be able to do from their eyes, right? So these are the examples I can think through, that if you can come out with a business model where both AI and the labor are becoming complementary, we probably can create some of this business at a faster scale as compared to what in the past. And secondly, this AI and this adoption thing, right? It doesn't have to be an exclusive in the nature. I'm hopeful for one reason, that India has always been a late adopter of technology, but when it adopts, it becomes one of the champions of the technology, specifically for deriving the economic benefits out of the technology at a scale. I was a telecom analyst in 2010, and there was a concern at that point of time that the mobile internet is picking up in the whole world, and India is probably going to left behind. And in 2026, when I look back, we are the outside China. Our two mobile networks are the largest 5G network across the world. I know name of the countries which are 4 to 5 times of GDP per capita, then higher than ours, yet they still don't have a fully functional 5G network to the scale what we have in our country, right? So this is an example where it gives you a hope that, look, we have entrepreneurs who are always, when the technology starts to become cheaper and accessible, they don't hesitate to deploy capital and take advantage of the situation, right?
Right.
Possibly something of the similar nature should happen in the sector. Although I do believe that we need to invest. We may not have the luxury of 10, 15 years like what we had in the past. Probably a little bit more sense of urgency is required, where we need to shorten this investment cycles, and this investment needs to happen. And thirdly, when you speak about the dark factories, look, in the dark factories, it's either about technology and it's about the capital. Everything else, I mean, power is cheaper here, there, all. So in rest of the parameters, now we have started to match. Energy is cheaper in India, or matching as compared to, let's say, rest of the world. Where we don't have the access to is the technology, right? Which is where I spoke about that, look, if the FDI starts to happen in the country, for example, Europe FDA and some of those trade deals happen, this investment coming into our country and some of those dark factories get set up, that itself can give boost to the manufacturing. It doesn't have to be only in one country. And one of the way to think about would be even a dark factory need to be constructed somewhere. Now the cost of construction in India is probably 1/4 of what we see in United States, right? So while everything else being same, you still can put a dark factory in India and still be better off with a domestic market which is probably as large, if not bigger than in many of the US companies. I know, some of the audience may find it surprising. I know there are metal parts manufacturers who are supplying bulk metal after paying about 25% duty, which is being enforced on that. Yet we are 25 to 30% cheaper than the goods that's produced in the US, despite paying the duty. So that makes me hopeful that there would be arbitrages, there will be opportunities in the place, which will allow entrepreneurs to use India as one of the geography where can start putting some of those factories. So I'm generally an optimistic person, but I do think some of those opportunities will be out for India also.
Sure. Thanks, Rakesh, for that. Just when we thought many of the negatives are behind us, this monsoon is causing some concerns, as El Nino, etc. So, how do you think would be the impact on the theme, manufacturing theme, and our portfolio?
So look, monsoon is usually for our country, when we talk about our economy as a large, usually impacts the rural economy and the rural consumption the most in a very direct way.
Right.
And I do think that there's a area of concern if the forecast what people are talking about
Right.
starts to place, or we would see some hits around that. The impact on the manufacturing is kind of second order in nature. What I can think through is, for example, tractors, two-wheelers, FMCG, some of the names that probably will go through this cyclical downturn if the negative outcome of the monsoon starts to play out on the rural economy. Possibly some of the agrochemical names where fertilizers, etc., gets used for crop, the demand for them possibly could come down. Some of these are narrower pockets that probably could take a hit on the portfolio. We don't have a very large exposure to them per se. Having said that, some of the cyclical downturn actually presents opportunities for portfolios, because that is a time you can get some of good businesses at a good price, which possibly you were looking at it and were not available. So I'm of a view that if it plays out, we'll get better opportunities to pick up positions in some of these names possibly.
Sure.
As of now, we don't have very large exposure to the theme per se.
Let's discuss the portfolio in greater detail. So, which are the key sectors that we are overweight on? And I'm sure, first of all, the manufacturing theme is a very wide one. I think hundreds of stock, maybe 600-700 listed names as part of our universe to invest in. So, which are the key sectors? Is it a bottom-up approach that you follow, or you have sub-themes within the overall theme that you look at? And where do you think the valuations are much more maybe attractive or reasonable?
My investing style is more of bottom up, where we try to find ideas where we have good earnings growth with very strong fundamentals, strong management, and in a favorable policy environment. Also, the price has to be right. You don't want to overpay for a business, even though the growth could be very high, because we have seen in the past that several of the times those proven to be detrimental to long-term stock returns. It may give you good returns in the short term, but long-term stock returns could be detrimental, because you never know when the themes gets over, right? So keeping that thing in the mind, that the endeavor is always to find out the bottom of ideas. Having said that, we also take a risk view of the portfolio. You don't want to be under indexed to a particular or over indexed to a particular sector, because that creates the issues around the performance, right? In that context, when I look at and you look at our portfolio, we have large overweight on industrials.
Industrial.
Right? We have large overweight on energy. We have some underweight on auto as a space, but within that you would realize that personal PV is an overweight, but then two-wheelers is not an overweight. So you need to figure out those pair ideas where you can borrow money from one a pool of the market. And
is that because of the rural thing you spoke about?
Part of reflection is part of that, and where we think that rest of the market is not done. I mean, rest of the space or the PV space is still not done well. There are more concerns. We don't think so those concerns are as valid, or we think that the more value is in some of those stocks relative to how the other stocks have done. That is where some of the stock picking goes away. But the fundamental construct is to pick up the ideas which will have strong earnings growth from next 2-3 years perspective, in a favorable policy environment and available at a right valuation.
We've seen some correction in the markets, and there is some pickup also
Right.
we've seen. But from an overall market perspective, uh, uh, where do you see value? I mean, from a valuation perspective, do you also see the capitalizations, large, mid cap, small cap split? Also, you can talk about how is our portfolio constructed within these three, and where do you see the value
Right.
lie at this point?
While there's some correction that has happened, but unfortunately, there are no clear pockets where there's absolute value and you say, okay, this is the best time for the investing, right? So we are looking in this construct. You need to find out ideas where there's a relative value available and there's supported by strong earnings growth, because that is where the alpha is going to get created in some of those names. So I cannot pinpoint one particular sector where I could argue that the valuation, and even if the valuation is cheap on a headline basis, you would see there are concerns on earnings, which means that the valuation what you find cheap
prices
is optically cheaper. It's not necessarily cheaper in the construct of the fundamentals, right? That's the way one has to sort of look through. You pointed out the market capitalization framework. I think what we look at it is, when you look at our portfolio, it is about roughly 50% large weight, and the remaining 50% is split between mid and small. About 25% is in the small cap. Now, this one way to think about would be, when you look at headline index of small cap, you will always come with a conclusion that the small caps are still expensive, not only in absolute terms, but even relative to the large cap markets, right? But we are talking about a small cap. Every 251 stock, every stock after 251th ranking in India is a small cap.
Right.
And even if you take investable universe to, let's say, about 1,000 stocks beyond that, to say all the 750 stocks, remaining stocks are overvalued, I find that's a little bit of a misnomer. Our job is to figure out those 20, 25 names or 30 names where you could find absolute and the relative value. It could be in the small cap space, but could deliver, but the businesses have the ability to grow at a scale. Not necessarily in 1 year, but over 3-5 years, you see these businesses can become larger in their nature and therefore give you that disproportionate, alpha. That is how they focus when we look at the small cap names. Large cap is more of a trying to figure out relative value ideas, because some of these large caps by nature have become large. I mean, the law of the numbers is working against them. It's unfair to expect every large cap to grow 20-25%. I think it's not possible. When our nominal GDP is growing about 10-12%, large cap, it's difficult to grow beyond that number. Even a growth 1.2, 1.3 times nominal GDP is a very, very good growth if it comes from large cap, right? But what one can do in the large caps is figure out the businesses which will grow faster than the rest of the another large cap, and there could be a relative value between those two stocks. You choose one over the other. You hope that the stock does well, and that is how you create alpha for your unit holders. Mid caps is a bit where I find it's probably one space where the valuation is most stressed. Possibly it's the nature of the definition of the mid cap. We have 150 stocks. They are the ones who was growing the fastest. In the last, if you look at the earnings growth of last 1, 2, 3 years, you find the mid caps are the one who are growing the fastest. So not every mid cap stock is priced imperfectly. So you need to focus on the construct of the earnings growth again, and then look for the relative valuation.
You think that will continue?
Possibly so. As long as the earnings growth is there, I think possibly so.
What are the 1-2 sectors you are avoiding?
There is no clear avoid, because price and the earnings becomes, let's say, the dimension to look, right? Sometimes you find stocks even in the most avoided sector. Sometimes the best sometimes the best money making ideas are there when people are not wanting to look the sectors. I wish there were more sectors where people were not looking at in that perspective.
So it's much more bottom up in your approach.
That is correct.
Okay, let's talk about the performance of the theme first. So correct me if I'm wrong, in the last 2 years, it's been just over 2 years since our launch, and this theme has outperformed the overall market.
That is correct.
And for us, in terms of our performance, what are the 1-2 reasons why, what are the detractors, what are the contributors, if we can discuss on those lines? Is there any 1 or 2 sectors that pulled us down? Is there 1 or 2 sectors that has pulled us up? Yeah. Is there any?
I think one of the, so your assessment is absolutely correct. I think one of the large detractors for us has been, I would call metal as one space where we were underinvested. And one of the reason being that, we thought there's a better relative value somewhere else in the context of the earnings growth. It's very difficult to forecast wars. Unfortunately, when the war happens, the commodities are the one who always get the most premium. So that part of the performance is reflecting on our portfolio. But if I look at a longer period of time, right, we have seen that it's very difficult for a metal as a sector, as an aggregate sector, to continuously outperform. It's always the bottom up ideas in that sector that will do well. Why? Because one or another management is probably investing ahead of the times, creating capacity at a right time, and the price comes, right. So we are aware of those opportunities, but I think as a sector as a whole, probably over a medium term will not be of a alpha creator, and hence whatever we have lost in the short term performance, ideally we should be able to cover it up from our bottom up stock selection as the time progresses and the earnings growth elsewhere comes through. And secondly, your question was, is there anything else to pull out? I think one of the things is, most of the portfolios, India is a country which is importing energy,
Right.
which means that it's very difficult to avoid that import of that energy part from your portfolio.
Sure.
Because either it will be commodity or it will be some imported component which probably would have some linkage to commodity, or probably even direct import of energy, right. So in our case, because energy was also a reasonable overweight in the portfolio, and you saw Indian energy is actually negatively correlated to the oil prices, unlike let's say America or Brazil, who get positively benefited by the higher oil prices. In Indian case, it's other way around, right. We get benefit when the oil prices on the subdued side. I think we were placed in a way we were expecting subdued oil prices in the context of a very large oversupply that was expected to come even before the war. And obviously, because of the war, the oil prices, everybody knows where it went. That also had a detriment on the portfolio. For example, we also discussed automobiles, right. One of the reason automobile sector is not doing well, there is a concern on the margins. One of the reason the concern on the margin is the higher commodity prices. So in a way that some exposure to the energy space directly or indirectly is bringing the performance down.
But from a 5-year,
But from if I take a slightly longer view,
Yeah.
if I take a 3-year or 5-year view and look at the portfolio construction, I think we are in the right direction, because these businesses, while they might have a quarter or 2 quarters of margin pressure, one thing we always assess is whether the business has a pricing power or not. Fortunately, we are confident in most of the businesses in our portfolio have characteristics of pricing power.
Sure.
Even if the prices remains at an elevated level, they'll be able to pass them on over a period of time, right. And therefore, the concern on the earnings and so on and so forth should be going away, and the stock performance should ideally follow after that. So if I look at that construct and then I look at 3-year view and the portfolio construction, I think we are reasonably placed to take advantage of the broader thing, which is that Indian consumption is increasing across B2B and B2C space. Which are the businesses who will be able to take advantage of that, or all the bottom selection ideas is driven by that one particular theme, will be able to take advantage of some of the scales.
Sure. So before we conclude, the most important question that we get from our investors, so can we use this correction from a 5-year view? I'm not asking 1-year view. From a 5-year view, can we enter the market with lump sum in the manufacturing theme?
On a lighter note, when you call it 5-year, I think 5-year is a short term. I think, a long term horizon should be even higher.
Sure.
But I mean, on a serious note, I think if one is looking at this theme, they should have a very long view. Simply because, the parallel I can think of, an IT theme, how IT played out in our country over 20-25 years is probably similar to where manufacturing would play out over a decade or even more so. And if that be the construct, best is that when you think of this opportunity, you think in that horizon, because that will put the construct in the, the mind construct in a way where you will be able to, put money and keep it in a way that, okay, this is the amount of the money I want to keep it for 10-15 years, not necessarily for 1-3 years. If you have 1-3 year view, I would say that, these are risky investments. 5 and 10 is probably a right way to think about this theme. More 10 than 5, I would argue.
Thanks, Rakesh. Truly insightful. Would like to thank all the audience who have joined in today. So consider investing in HDFC Manufacturing Fund. Thank you again.
Thank you, Ram. Thank you. Thank you, everyone.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.